Hello, welcome to the Jackson Stapleton Accountants Budget Day podcast. So, as the sun rose over Westminster this morning, anticipation surely would be filling the air. Everyone's eyes ready to be glued on the Chancellor's podium, eagerly awaiting the plans for the nation's finances. So, in the past, what's Budget Day brought? Well, celebration for some, controversy for others, and a bit of everything in between. But one thing is for sure, it sparks passionate debates and shapes the economic landscape of our country. So here's my attempt to boil it down into something that's hopefully slightly more understandable. Looking at my notes that I took whilst the budget was taking place, which was just a little over an hour ago, we've seen announcements on alcohol duty, fuel duty. We've had a statement as to where the country's finances are in terms of borrowing. We've had an announcement on the VAT threshold limit. We've had an announcement on the capital gains tax percentage for residential property disposals. We've had a scrap to the non-dom status, so that was one in the eye for Labour because they've been really calling for that for a while. We've had an adjustment to the child benefit limits, which is a temporary limit, moving towards something else for the future that is supposed to be a fairer way of reviewing that. We've had the confirmation of the change in the national insurance percentages, something which you've probably seen in the newspapers for a while. And we've also had the announcement of a British ISA. Now, as time goes on, as the budget document is released for people to review, there'll be further things that come out. And of course, as you'll expect us to do so, we'll update you. So what does it mean for you, the listener? Well, national insurance. If you are employed, pay as you earn, receive a pay slip. Presently, once you go over the earnings threshold for national insurance, you are paying 10% national insurance. Now, if you cast your mind back to the last time Jeremy Hunt stood up on this, there was a reduction to the rate of national insurance for you to pay from 12% down to 10%. You'll be pleased to hear that there's a further reduction, which basically takes national insurance down to 8%. Now, for self-employed individuals, so those that have their income assessed via a self-assessment return and are deemed as self-employed, there is also a reduction in the national insurance percentage for you. So that's come down from 8% down to 6%, having been 10% this time last year. So in terms of national insurance, what we're seeing there is a genuine reduction, and people will see that in their payslips. They will see more money in terms of in that net pay column. And for the self-employed individuals out there, they will see a reduction in the amount of national insurance that's levied as they declare their results to HMRC. Now, the cynics out there will point to the fact that income tax thresholds have been frozen and have been frozen for some time. So what does that mean? Well, that basically means that as the value of money goes down via inflation, more people are being dragged into higher rates of taxation, which they call fiscal drag. Basically, if somebody receives a pay rise and it pushes them into the next threshold, because those thresholds aren't going up or aren't keeping up with the value of money, then more people are actually paying income tax at higher rates than ever before. So the the national insurance reduction is something to be celebrated. However, we also have to take into account the value of the pound in our pocket and the rates of tax that we're paying as our pay is adjusted if we're so fortunate to have a pay rise. So that's the national insurance side of things done. The next thing, VAT. Now, this is something that's been looked at for a while now, and the frustration from many of my clients in terms of the threshold, again linked to the value of money, is the fact that the registration limit has been £85,000 for so long, has resulted in businesses that were miles away from VAT registration, say 4 years ago, either getting very close to that or actually exceeding it and having to register. Now, before anybody celebrates and thinks that they need to deregister, the increase in the threshold is a fairly modest one. So in terms of where we're at this moment in time, if your business exceeds £85,000 worth of turnover in a 12-month period or less, you're obligated to register for VAT. This threshold will increase to £90,000 from the 1st of April. So if you're around about that limit and administering that at this moment in time, you've been given a little bit of breathing space in terms of not needing to register. But bear in mind that is actually only around about £450 a month increase to the threshold. So it will benefit some businesses, but it's extremely marginal on that front. So that's VAT dealt with. So what else did the Chancellor announce? Well, I'll talk about the scrapping of the non-doms status, purely because I think that's something that the Chancellor has had to acknowledge, that it's not particularly of flavour for people to hear that it's possible to pay an amount to live in this country and not essentially pay the same taxes as other people that do. It's been building for a while. A lot of that's been aimed at Rishi Sunak, given his tax status prior to being Chancellor and Prime Minister. So they've relented on that, and there is a transition from that status being available to no longer being available. Of course, the Chancellor remained quite loose with the terminology and how that transition will actually play out, and I'm told, and having read it, that will take around about 4 years for that to come through. So basically, enough time for the next government post-election to decide as and how they really and truly want to deal with that. So took a little bit of the political sting out of that argument with reference to Labour really pushing that home at the Conservatives, but as with ever, the detail isn't actually that full at this point of time. So I think one there really more of a political one than anything else, if I'm honest. So right, the next thing that I'd just like to look at going down the notes that I made was the change to property tax. So the Chancellor says that the government will reduce the high rate of property capital gains tax from 28 to 24%. And he also announced the abolition of stamp duty relief for those buying more than one dwelling, should I say. So the belief here from the Chancellor is that actually reducing the higher rate of tax will produce more activity and then therefore yield more tax in total, which is a fundamental belief of many economists, that the lower the rate of tax, the more activity that there actually is. So it depends which side of the fence you sit on as to whether you agree with that. Child benefit's a really interesting one. So we're getting a consultation at last on child benefit, because for anybody that's aware, we have this cliff edge moment where if anyone within the household earns more than £50,000, then that household isn't entitled to child benefit, or that there's a taper from them being entitled to child benefit. What actually has come out today is that the top taper of the withdrawal for the benefit will be raised to £80,000 from the current £60,000 limit. So, and also the amount that causes this problem will be raised from 50,000 to 60,000, and I believe from there, in this next year or two, the Treasury are going to look at some kind of household income calculation or allowance, if you like, to decide whether people actually truly maintain their right to claim that amount. For those of you that are concerned or bothered, if you like, about the overall borrowing position of the country. Now this can be something that's a little bit of a turn-off, but this really does affect pretty much everything that we do. The market's confidence in the government and interest rates and things like that. Within the statement today, Jeremy Hunt has stated that underlying debt, which excludes Bank of England debt, will be 91.7% in 24 to 25, then 92%, 93.2, 93.2 before falling to 92.9 in 28-29. What they mean by that is the amount of money that the government actually borrows in relation as a percentage to, as a country, what our total output is. And this has been a long-standing metric for the strength and resilience of any particular country. It's a percentage that's used worldwide. Now, in future podcasts, which we're excited to announce that we're going to be bringing more back, we will talk about more economical aspects as well as just the taxation, just to give people a little bit of flavour. So if they're ever listening to these statements, they can understand them a little bit more. But it is a relevant point, and it does affect our interest rate. So it's something to be aware of. So that's where I'll leave that point. In terms of full expensing, which is basically something that relates to the capital allowances. He has announced today that full expensing will also apply to leased assets, though again from my notes I wrote TBA next to it, which would be to be announced, and that basically means that the Chancellor has decided to put out that they're going to allow full expensing on leased assets, i.e. the same essentially as assets that are bought either by cash or by hire purchase, but it doesn't actually seem that they've given the method as to how that would work. So again, that's a point that we'll follow through and we'll put out to everybody at the relevant point. But it will bring, for the first time that I've ever known in terms of accounting, the treatment of assets on hire purchase or purchased without finance and lease assets to be exactly the same in terms of the timing of the allowances for the relief. So that could have more of effect than it really sounds, and hopefully once we've got the clarification as to how the government are going to facilitate that and allow that to be claimed, we can actually do some calculations, and it may shift more clients from either being lease focused to hire purchase focused, or purchased outright if they're able to, or vice versa. So I am quite excited about that one. So if you've got quite a number of assets, or you're intending to buy some assets very soon, I would take a breath and speak to us or your accountant, if you're not with us at this moment in time, and get them to run the numbers on that, because it could really influence where you go with that decision. So in terms of the budget overall, as I've said, we're just looking today just to go through the main points. And for the listeners of this podcast, I believe we have covered that. Of course, this is a budget in an election year. We know there's going to be an election, we just don't know as to when. So in effect, over the coming months, we'll receive some mini budgets through by way of each party's manifesto. And as again part of the podcasts that we're bringing back, we will look to profile them and explain what they mean for you from the taxation point of view. And of course, we'll go to the vote, and then whoever has sufficient numbers will implement that manifesto. So it's going to be a year, certainly for this country, whereby we're going to be talking a lot of different things in terms of a lot of different rates. Some of the arguments, I'm afraid, will be over something that seems bigger than it is, and probably not as focused on areas as it should be. But we'll hopefully highlight that to you and let you know what it means. And for the wider world, of course, we're in a year where 50% of 50% of the democratic vote is scheduled to happen this year. So we have incidents or we have events, should I say, beyond these shores that will ripple through to our own economy. So it's really time to plug in and listen to these events and sort of let it shape your decision making for your businesses. I appreciate there are other factors that are never part of the budget these days that you'll be keen to hear. Matters such as inflation and interest rates. That's something that many people are predicting the inflation to continue to fall, which will give the Bank of England more room to look at what they do with the interest rate, the base rate as they have it at this moment in time, which will further impact into what we pay to borrow that money, which influences whether we decide to do it or not. And there's a wider thing over this next couple of years, as an economic aspect that we've got to consider. Lots of businesses are a midterm way through their COVID repayment cycle, and we're going to see those businesses getting to the point whereby the debt has been repaid, and they'll have that room in the balance sheet, i.e. no longer paying them amounts out of the bank, or they'll have a serviceability uplift, and they'll be able to raise further finance. So the next couple of years could be really interesting for businesses, and with plenty of growth opportunities. So they're things that will intertwine into world events and national events. So hopefully you found this return to us putting a podcast out to be useful. We're definitely going to be doing more of these. I just want to apologise for the few of you that wanted the live that we couldn't make it happen. I don't know if that was the staff making sure that it was for my own good and safety that we didn't attempt to live on our first one back, or it was a genuine technical issue. Hopefully it was the latter. So anyway, we'll be looking to do more lives. We'll be looking to do more podcasts. We're happy to field your questions. We're going to be getting some guests back on. We're really going to be striking this back up, and hopefully you'll find this a useful bit of input for your business and your decision making. So thank you very much for listening. I'm your host, Mark, and I look forward to speaking to you very soon. Take care.